Welcome to How to Retire on Time, a show that answers your retirement questions. My name is Mike Decker, founder of Kedrick Wealth, and joining me in the studio today is Mr. David Franson. David, thanks for being here.
Hello.
Get your questions answered on our show by texting them to 913-363-1234. Again, that number, 913-363-1234. David, let's dive in.
Hey, Mike. How come financial advisors make money even when the client loses money?
Yeah, this is a very fair question. One that I have struggled with most of my career, admittedly.
Yeah. Okay.
And from a regulatory standpoint, there is good reason. Not everyone loves regulation. I tend to actually appreciate a lot of these regulations that are here because you have to understand, why is the rule there? What happened? What advisor did something really dumb that caused regulators to put in a different rule or a new rule? So fiduciaries and financial advisors in the public sphere, okay, the ones like you would work with, for most people that are listening in, they don't have performance-based fee structures, as in if you make money, they make money. If you don't make money, they don't make money, because it may incentivize the advisor to take more risk than is appropriate, trying to maximize their own pockets. That was at least the intention behind this. So the traditional fee structure is really around like 1%, 1.5% typically what I've seen advisors charge. And it's whatever you're making up or down, their job is to try and help you navigate through the storms, to the good times and the bad. But yeah, it is kind of a funny situation when you think about it.
Yeah. Yeah, it really is.
But it's intended to bridle greed and to help advisors be more of a fiduciary and less of a hedge fund. Now, hedge funds, if you're an accredited investor and you've got enough money to meet their minimums, yeah, you could put in a hedge fund, and that's where the performance fees are. Many hedge funds blow up because they take on that extra risk. Many hedge funds struggle in certain times, and there are many hedge funds that do wonderful.
And are hedge funds really for like average investors, or are those just for like the high rollers?
It's for those who have multiple millions of dollars. And then there's often like a $2, $3, $4 million minimum just to have them manage your money. So it's not a common thing. The everyday advisor, they're trying to make it advisable for individual. Now, there's a second question on the fees that I think needs to be addressed, and it's net of fee performance.
Okay, explain that. Yeah.
There's two sides to this. The first side is, what are you paying the advisor to do, and what's the objective? And then the second side is, could you do it better on your own? The second side is often based on ignorance. I'm not saying people are ignorant deliberately. You don't know what you don't know. So if you tell an advisor, hey, I want to grow my assets, but I don't want a ton of risk, you're probably never going to beat the S&P 500. And so when you say, well, I could have just bought the S&P 500 and beat what I'm paying my advisor to do, that's true. But you're also taking greater risk. And when the markets go down, all of your money is going to go down. So the advisor is trying to give you more of a steadier, consistent growth on that trajectory. So you think, well, what am I paying you to do? It's to do the research to put together a portfolio that is suitable for you, that fits within your emotional limits. If you don't like that, if you want to try and beat the S&P, let your advisor know. They can get more aggressive, but it needs to be suitable, and you've got to understand you're taking more risk. You can't separate risk and growth potential. And it's not more risk, more reward. It's more risk, more potential reward. So that's one layer of all this. But the other thing that I think is very interesting is you can buy stocks, mutual funds, ETFs on your phone. There is no barrier of entry for these publicly traded investments. So if you wanted to do the research, if you want to manage your portfolio, maybe you don't need an advisor.
Is that a controversial statement?
Yeah. I wrote an article that went on Business Insider some time ago that said how a comprehensive plan could replace your advisor and save you fees. If your advisor is charging you 1% and you're just sitting on a bunch of mutual funds and ETFs, I think that's kind of like a participation award, because you could fire the advisor, keep the same portfolio, and you got 1% better performance. You're paying an advisor, in my opinion, to actively trade your portfolio. Now, does that mean you're actively trading all of your portfolio? No. I mean, for our portfolios, we have a component, or part of every portfolio just has the S&P 500. Could you do that on your own? Yeah. But we're trying to smooth out some of the volatility, the ups and downs, as we're also actively trading other parts of our portfolios. but you're paying your advisor to get you a better return than you could on your own according to the suitability that you have. That's your basic function of a financial advisor or an investment advisor. Now, here's a caveat. What else is the advisor supposed to do for you? I mean, really, what other services are you asking of your advisor? That is one of the most fundamental questions. And I think people are often shocked when they approach this of what actually is being offered and what they're not getting. And you don't know unless you ask, okay?
Right.
You don't know what you might be missing out on unless you just don't know. So let me tell you a quick story. A couple of weeks ago, my son was choking on a pancake. Very difficult situation. He couldn't cry. He couldn't call for help. We got lucky. We noticed that he was in tears. He just started tearing up a little bit. He was holding his throat and he didn't know what to do. And so quickly we sprung into action. Now let's pause real quick, okay? Choking kills people. People die every year from choking. It's a very serious situation, especially when they can't cry or vocally speak. It is completely clogged, okay? So what are my options? I have one option, quickly drive him to a hospital, which was a 15-minute drive away. Probably would have significant damage to some part of the body. I'm not a medical professional, but I'm assuming if you don't breathe for 15 minutes, you could die and or suffer severe health issues with that.
Right. Yeah.
I could take him to the urgent care clinic, which is about 3 minutes away, quick drive from my house, or I could give him the Heimlich and just clear it right away. So being your good old Eagle Scout from when I was a kid, quickly sprung into action and I cleared out the throat, couldn't get it all out, gave him the Heimlich, a child Heimlich, not the adult one where you could break ribs or whatever, but gave him the Heimlich and it came out and started vomiting. Traumatic experience. Now, you think that we would be resolved at that point, but it wasn't. He had a horrible bark. Now, this is a pancake you choked on. Part of the debris could have gone deeper down into the lungs. If it goes down into the lungs, it could create additional issues. And maybe his airwaves are still partially blocked because of this horrible bark. He still says he can barely breathe. That could be from hysteria. It could be from a partial obstruction. So what do? I drive to the urgent care. I walk in there. I say, my son's choking. I did the Heimlich. He's now able to speak a little bit. They could hear him cry. I said, but there's still something I think that's in there. Can you help? This is what they said. They said, we'll get the doctor right out here. The doctor comes out pretty quickly and says, we can't help you. Go to a hospital. Let me just dwell on that for a second. I'm going to an urgent care clinic because my child has been choking.
Yeah.
And they say, we can't help you. We're doctors. We're medical professionals. And we can't help you. Go to a hospital. So my child is now choking. I think he's choking. There's a horrible bark. He's hysterically crying. I'm doing everything I can. And I drive to the hospital. We calm him down. Things ended up okay, right? We were on watch for a couple of days to see if there was anything that got into his lungs, and we took x-rays and did all sorts of stuff. And he's fine, thank goodness. But you would think that an urgent care clinic would have been able to at least stabilize and verify that he wasn't at least partially choking. No guidance, nothing. The reason why I bring this up is many people assume that their financial advisor can give them comprehensive and holistic advice. Many advisors can't. They can't give you tax advice. They're not licensed to give you the insurance advice. Maybe they can give you a couple of insurance products, but they really don't know what they are. It's just kind of like they can explain it away real quick. Many financial advisors, they can't do tax returns. They're not talking about your estate plan. They don't know that if you have over $12 million, you maybe should have considered an AB Credit Shelter Trust to not pay a ton of estate planning taxes. You go down this list and you start to realize your advisor had one purpose, and that was just to grow your money. But retirement requires so much more. And it's that eye-opening moment where people start to wake up and say, well, maybe I should find someone else. Okay. Now on fees and all that, there are other layers of issues with fees, but you have to ask yourself, what are you paying? And are you getting the value of what you're paying? If you've got $1 million, you're paying 1% in fees. Guess what? You're paying $10,000 for what? Is it the same model everyone else has? Are you paying $10,000 to have a friend to call once in a while and ask a question about the market? Are you paying, is it 1.5%? Are you paying $15,000 for this $1 million portfolio just to, I don't know, have someone buy and hold for you?
Check in once a year and say, yep, these are the mutual funds you're in.
You have to start to ask, are the fees worth it? Now, there's another line that needs to be addressed here. And by the way, just for context, because obviously we have fees at Kedrick Wealth, we subscribe to the CPA model of fees. We charge a flat fixed fee, like a subscription or a membership, or based on how much time does it take to do the thing that needs to be done. So if you're just growing your assets and we're just doing tax planning on the growth of your assets, we're managing your portfolios in the market, we're doing the insurance planning, we're reviewing the estate each year, that's a simpler situation than if you're retired and we're having to take income, plan your RMDs, and so on. But if you have $1 million, $2 million, $3 million, $4 million, $10 million, it's the same price because we charge a fixed rate for how much does it cost to do the job. And now we can actually line item, this is what you're paying for to the hour. This is what you're paying for. This is the time it takes to do it. Do you want it? Do you not want it? And now it actually makes sense. At least we can explain it. Instead of this 1%, but you get the same amount of, it feels weird. This person's got 500,000 invested with this advisor. This person's got 2 million. They both kind of get the same attention, the same service, but one's paying significantly more. It does not make sense today based on how the technology and the industry functions. I get how it was in the 70s, having to call in every trade. The more shares you had, the harder it was to offload or to buy. But today it's simple. And yet the industry has not adjusted, in my opinion, to be what's best for the client. Fiduciaries, and we're a fiduciary to do what's right for the client. We're legally bound to do that, but they haven't updated how fees should be done. So the question here, how can financial advisors make money when even the client loses money? There are so many potential issues, in my opinion, on how fees are done that I think things need to be reconsidered. And I think this is why there's a huge exodus of DIY retirement plans, because many people can't rationalize the fees for the services they're actually getting. And I think as people are continuing to do their research, they're waking up to maybe they're paying more in fees than they realize. Did I answer the question?
Yeah, I think so. Yeah, you've touched all the bases there. It sounds like what you're saying is that technology has disrupted the industry enough that we're at this sort of turning point where we need to reconsider maybe the industry, why they charge what they do. Is that fair to say?
How much are you paying in fees and are you getting the value for it? Because if you don't check that, there's a good chance you might be the annuity to the advisor, that you're the residual. They're getting a participation award of just having your assets sit in some funds and they're just overseeing it. It's very easy to oversee something and that's all you do. It kind of breaks down the integrity of the financial services model, in my opinion. For everyone here that's starting to kind of wake up a little bit about that, you're wondering, well, how much do I have in fees? Ask your advisor, how much are you paying in fees? And not just fees on like the 1% that they're charging, but find out, do you have mutual funds? How much fees are associated with the mutual funds? How many fees are associated with your ETFs? How many fees for all you've got the variable annuities? There's like 3 or 4 layers of fees that you're paying. Add them all up. If you don't know what your fees are, I haven't personally done this, but I would assume that you could probably upload some stuff to your AI of choice, whether it's ChatGPT, and it would probably break down how much you're actually paying in fees. Get that total and then ask yourself, am I getting the services that are appropriate for the amount of money that I'm paying? If the answer is no, consider looking around. That doesn't mean you should just DIY your plan. It means maybe you ought to look for someone that would charge the same amount or less, but offer you the same or more services. It is possible. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.